Good afternoon, everyone. I'm Dan Hussey with Zaner Ag Hedge, bringing you our Strategy of the Week update here for August 3rd, 2023. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. Although, if you do want to talk to me a little bit more about taking these ideas and turning them into a trade plan for you, you can always get in touch with me over here at Zaner and or with any of my esteemed colleagues to discuss trading plans and marketing plans with you. In the meantime, let's go over some charts. I'm going to state a lot of technicals today because fundamentals, generally speaking, I think are kind of getting, I don't want to say thrown out the window, but I'm seeing a lot of very intelligent, logical thinking trade plans and people getting proverbially beat up in this market. Not to say there isn't a reason, right? Corn, is testing below $5, or soybeans have come under pressure as of late, or wheat is breaking back down, on the basis of, potential talks about, grain deals left and right. But, I think these markets are being a little more technically driven than anything else right now. And certainly the weather markets that we had hoped for, right, or that people were looking for, not coming to fruition, and of course seeing honestly better forecasts than we had anticipated for the month of July and now into August. Yeah, there's a reason you've taken that weather premium out of the charts as well. But the damage of June and into pollination for corn, remains to be, untested and unseen in the fields. And I personally, I've got a hunch that into crop tour here is when we'll finally rip off the blinders, or pull back the curtain, so to speak, to see excuse me there, to see how crop yields have actually fared. So I am getting back from a trip overseas here. Well, we didn't have a webinar last week. We didn't do some videos. I've been still working and following the markets, just not given my updates here, which are going to pick up again. So stay tuned. We're going to be changing, I think, the webinar series a little bit. It's going to be better, but we shall see how that turns out. So December corn. Let's actually pull up a daily chart first. 493, down 7 cents here into the close. And really, really putting pressure on any notion in the this last week that we had turned the tide, found a low, seasonal low, and started to progress higher. That doesn't mean we can't. This is just a very, 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 very deep pullback. And now testing back below $5 psychologically puts a major threat on the notion that corn should be up here at all. Going into next week's WASDE report, where here at Zaner we see new crop corn ending stocks coming in around 2,100 bushels compared to 2,262 in the last month. Old crop expecting no change there in our ending stock number. New crop production looking for it to be about 260 million bushels lower at 15.06 billion, with yield coming down maybe about 3 points, 3 bushels an acre on this report. Obviously, we feel that that crop yield will probably be lower by the end of the year, but we are anticipating, at least the USDA telling us, that there should be about a 3 bushel an acre reduction there. And then, it remains to really be seen what they do with that demand number that they threw in at the start of the year of 750 million extra bushels. I think that's how much it was of demand. And whether or not that's going to be there, we shall see. So the chart of corn, I think for 2023 right now, has been the fight over that $5 handle, that $5 threshold. And going over some of the levels, we're actually going to go and look at 2022 December corn here in a minute. But a gap down on the charts here to start this week at 525. Not great that we have not only gap down, but and ran away from that level, but it happened to be down to below this red line, the 18-day moving average. Certainly the close on Friday and bouncing off that level left me thinking, okay, corn just basically pulled, into a 50% retracement. We'll look at this on the 4-hour chart in more detail. But, going into last Friday, the market had effectively pulled back into 50%, closed, positively off of, or not positively, but off of the 18-day moving average. And for all intents and purposes, I thought as of last Friday, that was an opportunity that corn could, potentially head back higher, get back above that 55 and 100-day moving average into, Monday, Tuesday, and then run up to, retest that 200-day moving average where we found resistance earlier into the end of the month of July. That obviously did not occur, and the market hasn't really held any technical Fibonacci levels here, and we've just traded the range we've been in all the way back down and sub $5. Definitely putting pressure on the bulls and down into an area on the chart where if we slip below, we really haven't been, certainly we haven't been below the 481 low, since October of 2021 on December 23 corn. So this is a really kind of big line in the sand for corn at this point. That we want to see, the market hold above, for the bulls, and that bears would be looking for, to break below. And then how far down, it can go after that. I mean, 450 is the next logical guess, but I think there's, a bit of an inflection zone around 460, 460 to 450 where we, could find some support as, old resistance held as support during that run up in 2022 to new highs. I do want to take a moment though, and again, I guess we gap below to start the week, right? We traded yesterday all the way back up to hold that 18-day moving average, broken support now is resistance. That yesterday's resistance into that level is one of the reasons I am a little more concerned right now, and having rejected and come on all the way back on down in this range doesn't look great. We are oversold now today with our the close today. We are into oversold territory for the RSI. That doesn't mean it has to reverse from here right away. But right, if we are down into the low end of the range that we've been in since May, and the support that we've held for May, we would anticipate a bounce or something of that capacity to maybe happen here soon. Okay, let's get into the smaller time frame technicals for December corn, because we know the big levels, right? We don't want to go below 480. We're down into this 550 to 490 area, or $5 to 490 area, excuse me. But I kind of want to take a moment and flip over to December 22 corn. Not to say that it's following like an analog or anything, but I think the fight over the $6 threshold in December 23 corn is very similar to the fight over the $5 threshold in December of 22. Or excuse me, the $5 level in 23 corn, right, is similar to the $6 threshold in 22 corn. So we bottomed around the same kind of time in the chart. And you can see December 23 corn here on the right on that small screen. But if you kind of zoom in here a little bit, and we don't really care about later in August just yet. The collapse, from 760 down to the low here in July, it was kind of a bit of a double bottoming process there, right? It didn't look like a V-shaped recovery. It didn't look like the market just turned, capitulated, ran, and then started running higher. The market fell off, from 630 area down to 480 here just a couple month ago. Similarly, right, we had a collapse in December corn in 2022. with a move from 760 down to 560. I mean, a little bigger, but whatever, right? We had a lot of volatility. The market was moving around a lot. There was a run up. Before that, market came down, bottomed in July, and on July 22nd in 2022, we found a bottom. Well, we found that bottom here in 23 and on July 13th. Similarly, spent a week or so kind of messing around down there, and did, get a rally and get a bounce back up here to kind of, it took a few more days of liberty here this year, but we did get a rally from 560 up to 640 there. Well, we've had a rally this year from 480 up to 560. A little bit bigger of a rally this year. I think volatility has been a little bit bigger this year, but generally speaking, a 70-cent rally last year, and what's that, about a 90-cent rally this year, about the same magnitude. It was a little faster last year, I guess. This year had a little more up and down. It took a couple days of downside inside that pattern, whereas last year we kind of just went straight up for a week. We did see a pullback, though, to start August. And we found August lows on August 3rd. Well, not saying that today being August 3rd, we're going to find the lows for August, but corn did sell off from 640 down to 587, a solid 60, almost 60 cents there. To break back below $6, the big threshold at the time, only, to subsequently, rally thereafter. And even later in the month of August, there's a sell-off from 641 down to 604. So there's two, 40 and a 50-ish, 55 cent, whatever that is, sell-off, two of them in the month of August that retraced a little deeper than you would have liked to have seen it. In other words, the 50% pullback that we got we actually did get a 50% from 562 up to 643 right into 602. But initially, right, this initial pullback from the lowest low to the first high after, it was relatively deep. It went to 61.8 lines. It wasn't clean. There was an open gap we went down to fill and what have you, but then we didn't fill it. But I can make a case for this deep pullback, not technically holding fibs, and the market kind of being in this, generally sideways price action, fighting over the $6 figure in 2022, and say, well, it's kind of similar to this fight over the $5 figure we're having, and if this is all part of the bottoming process and we see follow through next year, or this year, we'd have to go up to fill a gap and get back above that 18-day moving average, but nevertheless, it certainly could, be a bottoming process that takes you, into September and October, where we found highs back in 2022. Okay. If we don't, and the market wants to continue lower, it's really hard to ignore that from the 679 area up to or down to lows here, that the market hasn't tried to trade into its 50% short. It hasn't quite got there. 572, it was a 579 level. Okay, I would have liked to have seen that trade, but it's still, let's not ignore that the market more or less made one really big step down or two steps down and tried to take one little step back here, if you will. And that if the market is really bearish, might have some of the technical setups, right, to suggest that it can be. I find, I find the nature of, this decline, though, to be a little more corrective, where the rally and inflationary pressures we had from 21 through 22 was the impulse, meaning that this is all just correction and that eventually we'll go higher. But that doesn't mean that the market can't, head lower in the meantime and head down to the 440 to 460 area and break below that low. So in the near term, though, corn has an open gap here at 531. Got to respect and think about that full 50% retracement from 572 lows to highs, or highs to lows after. So open gap at 532. So if we do rally up into that level and we don't just go through 530 and really get to 540 to 545, to me that could be a very technical short into the gap fill at 530 to 531. 50% lines actually at 532. So, if you're a farmer or a producer, that's a level to think about some sales on the way back up if it gets it. Um, and, particularly if you've already taken care of a re-ownership strategy and already have some ownership on the board. I mean, that's the whole purpose here, right? If we're to the low end of the range and we think that this is going to be a bottom, this is a time to think about call spreads. It's a time to think about limited risk for the upside, right? Where you can have a very defined bottom, maybe 480 is where you put your stops if you want to buy futures down here. I don't see much of a technical level to be a buyer at, right? But this is just under the notion of an actual marketing plan where we know we've already done sales or we've got sales to do, and this is a way of getting some finite re-ownership. I personally favor call spreads down here because if we're wrong and the market wants to break down to 440 corn or something, you have the short call on that you can get out of, buy it back for a gain, and use those gains to then roll down a long call in the past, and later. And this is particularly for re-ownership, right? And even for those that want to speculate and have limited risk for the upside for corn at these levels, that's kind of the nature of how I do it. I think the 530 strike's a good place to think about. I think the 570 strike's another good thing to think about. So back up for that gap fill, and then anything back above 570 I think would be, an interesting strike level to own. And that's not looking at the cost of these things at all, which let's take a look at that here for a second. Don't need the cotton. All right, as I mentioned, 570 calls there going out for December corn. They were going for just outright, 5 to 7 cents, bid at 5, offered at 12 right now, but they call it about an 8-cent, or 7.5 cents where they're trading last. That's something you can probably own outright. But the 530 call at 15 3/4. Wow, these December options have really, really come down in price. Maybe even just think about owning the 530 call outright at 15 cents. But truthfully, at this point, I'm thinking and have been thinking with clients about re-ownership going all the way out into, March or May of next year. And I think May is probably where I would structure my call spread into. Again, May trading at 515, a little bit of a premium here to the December. That's perfectly normal. So, at this point, we're probably looking at more like a 550 call rather than the 530. Maybe, if you could bring that down to the 540 for another few pennies, that's great. But 550, 650 call spreads, you're bringing in 7.5 cents here for the you're going to bring in about 8.5 for the 650, while the 550 is going to cost you about 26.5 cents out of the pocket. 16 cents for a dollar ride corn spread with 267 days left on it. I know it sounds crazy to want to buy corn, but if you want to start spreading or going to encourage calls on into, planning, sales down the road, that to me seems like a great way of making sure you're, reopened and the upsides reopen for the foreseeable future for you. And again, that 8.5 cents you bring in with a 650 call, that's protecting and can be some pennies that are used right if the market does continue to collapse. But I am worried about corn here. We're kind of down into no man's land, and this is a downtrend until it's not. But we are down to the low end of the range. And it's been hard to call any of this, anything but ranges until it's not. All right, let's move on to soybeans. And my apologies for my lack of energy today, but boy, oh boy, does a trip from Europe really take the wind out of your sails. Novi beans closed the day at 13.25. A little ray of green light there on the old board for the row crops. Today was kind of the break below the 200-day moving average and the test thereof as resistance. Don't love that, but something I guess I didn't. No, never mind. Something that is worth noting, I should say here, is that that 55-day moving average is just about to cross over that 100-day moving average. It's pretty good short-term development that we want to continue to see. 18-day moving average, though, to start this week, we gap below just like the corn. We ran lower into the 200-day. 200-day was holding, and today was kind of the fight and breakdown of that. And resistance today held right into that 200-day. So I'm not so certain we're not going to be heading down to the 100-day and 55-day moving average crossover to test, that level of support. But we are oversold in the daily RSI, and we will take a look at here in a minute where the big 50% retracement is, of this entire decline. And it's interesting where, how it aligns with it's at 1282. It's not a huge surprise, but it's interesting how it aligns with this 55 and 100-day moving average as well. And, kind of almost a retest of this old, where we found support last week, or I'm sorry, back in June. And we'll discuss that here in a little bit. But the gap lower in soybeans from 1379 is still open. And this is where I feel on the soybean balance sheet, we're going to be, if corn tightened up, right, and beans are going to tighten up, well, I think we were all a little, not shocked, but not happy to see a 300 bushel carryout in ending stocks from our last report out of the USDA. But currently, new crop ending stocks here at Zaner, we think they're going to shave off 21 million bushels down to 279. I think anything below there starts to get, excitingly bullish again for soybeans. And it's not because, 279 million bushels is an exciting number just from a pure stock to usage ratio, because it isn't quite pipeline beans. I mean, it's close, but, it's not. I think we will get down, into the sub 200 range on a carryout number this year. But of course that remains all to be seen. Soybean production, a little lighter by 41 million bushels, down from 4,300 million bushels to 4,259. With soybean yield, we believe, and again, this is not where we think it'll be at the end of at the actual end of the year. It's just where we think the USDA is going to land on. We think they're going to take a half a bushel an acre off here. I'd like to see more. I think we're all, many analysts and people I've talked to, I think, we saw the 52 number and we immediately started to think 50. Going below 50 though, I think is possible. I know that, the adolescent plant was, took some heat, some damage, and certainly was in drought conditions. But now, the question is how much of the decent weather that we're getting now or forecasted to will help and continue to help soybeans, as we get into their pod filling season here in August. So I do think the pullback we're seeing right now is kind of, just technically taking some of that out of the market. But I also think soybeans made a very good charge higher here in 2 steps forward, and they're doing their 1 step back. So are 1282 a big technical buy on the bean chart? We shall see. 4-hour chart for Novi beans. Starting to get down into the smaller time frame here. We had broken above the trend line resistance, right? We capitulated below that 1260, 40, 50 area, got back above it, held it as support on another test lower. 50% retracement at the time from 1130 low up to highs after. Traded almost to the tick, but I'll count, a 1256 print against the 1254 quarter level as the 50% retracement. And then the market, we all know what happened after our July WASD. We rallied all the way up to a new high. Market then inside of that whole pull did its own little 50% retracement. Entry low from 1257 up to the highs after. See 1324's pullback. Slam down to do a double test that level. Just typical beans. They don't make it easy on anyone. But then the market rallied up to the 1423 and 1436. Those are the two. I'm going to remove the full 50% right now. But these are the two polls that we had in the market. The two technical Fibonacci polls we had in the market that took the market via this supporting trend line up to the 1423 and 1436 respective targets. Once the target's filled, you immediately start thinking, okay, well, next in the series should be from a swing low to the high after. That would be, next in the series just from this low. Market came down. We actually gapped down into that level. So if there's any reason why we closed at 1382 and the next buyer was at 1375 where a limit order would be placed, it's kind of what I see happening there. But then they were immediately stopped out within the first 45 minutes of trade there on Monday. Market even went down to knife through the other fib polls next in the series on that same day. Triggered at 1346. They would have been stopped at 1324. And the market hasn't gotten much of a bounce since then, and leaving an open gap up at 1382 to 1378, however you consider a gap to fill, if you consider from the close or the price action of the day. We also moved below this upward sloping trend line around that same time and that gap below, and we've not been up to test that area of around 1380 as resistance, which to me suggests that maybe the beans aren't in a massive sell-off. Maybe we're just pulling back from a lack of buyers and there's profit taking. We shall see. Full 50% retracement off the highs from 1434 down to lows 1375, right around that gap fill. Very similar to corn now. If beans and corn rally up, watch those levels for resistance. I'm not saying it's going to be a sell there for a move lower. In fact, I would anticipate this market going higher if we get up there, but pay attention to it, because if we do rally up there, it has room to the downside, doesn't it? Well, next in the series polls have not held, so we just need to look at now the 1130 all the way up to new highs, the 1282 full 50% retracement. If the market were to go up from here, tag the 1375 area, its downside target is 1286. We already know the 50% retracements down there, and we know the 55 and 100-day moving averages are down there as well. So I think there's a high probability we test this 1280 to 1260 area again now in soybeans, and that's assuming that we just don't, we haven't already held, a bit of a low here into 1320, excuse me, and this prior low for the month of July. Going down on the smaller time frame chart now, like a 5-minute chart or something. There was potentially continuation lower here from the gap fill lower, or the gap lower. There, 50% retracement at 1352 might have held. Downside target with 1305. I don't like how from the highs of the month right to lows after, 1334 has traded as a small 50% retracement. Not getting much love, from 50% lines. We certainly closed the day right into one. But if we break back down below 1320, again, I think 1282 could be on the table. If we don't, we go higher above 1340. I think we could be reversing, this outside day lower that we had yesterday, but continuation lower after a day like that, suggests to me that beans just have further down to go at this time. I hope, for all my producers' sake that we're done going down, but the truth is the trend is lower, and the technicals I think might be pointing a little lower in the near term. And it's hard though for me to be a buyer in this type of environment, knowing the balance sheet we have for beans, and knowing that, hey, if the only reason that corn and beans are selling off here is because we're questioning demand more than anything, well, lower prices are the perfect cure for that ailment. So I don't know. starting to get a little overdone without much in the way of a retracement, um, and into crop tour in a few weeks. So it's going to be certainly um, a developing market. All right, so let's move on here. The wheat complex a little heavy today, um, down into the low end of the range for Chicago wheat. September Chicago wheat here can't get back above its 200-day moving average. Hasn't held any of its other moving averages as support, and really since May has been in the 620 to 770 range. Now that we've kind of unwound these last few days back down to these levels, if we don't hold range support here, one has to ask themselves, are we going to be revisiting that 588 low? We are oversold on that daily RSI, so I'm waiting to be a buyer here on the idea that this is a range until we get a reversal setup, or at least a day that turns green. It has a wick behind it. Oh, sorry, on the wrong charts here for you. But it seems to be very range bound for the time being. September KC wheat. It's been in a range for even longer, but this is definitely one of the bigger declines we have seen, really since Russia and the Ukraine crisis bid started to unwind. So keeping an eye on that here. We're down into the 760 area. We really haven't spent much time below there. So if there's support here, I imagine it's going to be right around here, but waiting patiently for reversal. August live cattle 178.50 last. Been kind of bull flagging here and fighting to stay above that daily 18-day moving average. Same could be said for the October cattle. I think they have rolled over a little bit more here, but today's price action suggests that they're trying. Fighting back above that 18-day moving average is a good development for the cattle. And if we do push higher, I do think they do have it in them to get to 180, 88 to 190. Below 179 and below the lows of today, I think we revisit the lows of this week. And the next big levels below us are 176 55-day, 100-day at 171, and the 165 200-day moving average. We've unwound the oversold conditions, so there's certainly room, I think, on this chart to the downside if it wants it. But this has been a pretty strong uptrend for the cattle, and they still are showing no relentingness to want to stop. Feeders, really no different here. Back pretty much to highs. Kind of look like they want to break out, which is why I'm not so bearish on the cattle right now. I think they could still continue a little higher in the near term. August Hoggy 101, stark difference to the October here down at 82. Gap lower in both of those charts below the trend line support, below 18-day moving averages here at 83.50 for the October. I guess we didn't gap below the 200-day, but we're coming down to it. We did gap below trend line though. There it came in at around 102. So I don't have much opinion on the hogs. I haven't been following them too much closely, but this chart kind of looks like it's rolling over, and certainly trying to find support, or will be trying to find support as it continues lower. Cotton had actually a pretty good close for the day. A little bit of a capitulating slide there below the 18-day moving average, but a close back above. To me, suggests all Cotton did was come back to test its old resistance here at 83, the breakout level that we already tested as support once before here in July on the 21st. We then ran up to new highs, and we've come back to test that 83 to 83.50 area here twice as support, and it is held. I think Cotton's going higher, and I think certainly with a break back above 86 and downward sloping trend line against the high, suggests Cotton, is heading to 90, 90 and above here. If you take a step back and look at the daily chart, you can clearly see how we have broken above downward sloping trend lines on this chart as of now, and arguably even come back down to some extent to test them, as support. Yeah, so see if Cant wants to head higher. And of course, we have an upward sloping trend line against the lows here that is holding too, but I anticipate the next push in cotton above 86 to take us to 90. Dollar index a little bit weaker here today. I guess it's kind of flat on the day, but generally speaking, we are, if we look at the continuation chart for the dollar index, you can see how there is very clear resistance. If we go back further, you can see that resistance trading multiple times up into this 100 to 102 area. We broke above it here last year. And then now we've come all the way back down to kind of go break back below that area, maybe even come up and test this resistance yet again and back into the old range we were in for the dollar index. So we continue lower below 100. I think 90 is eventually on the table, and the trend lower for the Dixie is there. And that should be another, component to the improvement of U.S. Export markets, and certainly a reason to think that agricultural products in general could find or be, looking and hunting out a low, right? If we want exports, if lower prices are going to entice exports of corn, wheat, and beans from the U.S., then a falling dollar is going to do the same. Resistance here on the dollar, the 200-day is up at 103. But I think we're getting, generally really close to that resistance anyway right now. Downward sloping trend lines would suggest it's right around that 200-day moving average, and that's assuming that we're not into some kind of fib or something at this point, and already testing into the 100-day and 200-day or 55 and 100-day moving averages, where we're actually a little bit above here today. So nice bounce for the dollar, but I don't think it's a trend reversal for the dollar back higher just yet. Well, that pretty much wraps today. Before we go, crude oil is worth a comment. Breaking back above downward sloping trend lines that had formed against the high above our channel lower, and after just a lot of consolidation, we finally have a crude market that seems to be trending higher. I think back above 82 to 84 here. Opens the door back up to 90 in that other downward sloping trend line. I'm not going to get too overly zealous yet and say we're going to 120 and above, but or the new highs. But for the time being, it does seem like crude has found a footing, and it adds to the idea that there are macros out there that should be supporting row crops around now, right? The falling dollar, I know the dollar over the last week has strengthened, but generally we're way down. Prices have been lower down to the low end of the range for agricultural products, and now you've got crude oil coming back up. So I think that ethanol and biofuel demand for soy and corn, I think that should, or biodiesel demand, that should be somewhat supportive here. But I don't think the world is convinced, that I'm totally convinced that we're going to 90 and above yet in crude, but certainly we're putting pressure on the levels that need to break for us to get there, and that have held right around 82 to 83 for the last year and kept crude oil suppressed. So, all right, thanks for bearing with me here today. I know I'm a little tired, a little jet lagged. Actually, wasn't feeling it till we started doing this video, but nevertheless, I'll be doing another one tomorrow with a little more detail as price action starts to develop. But yeah, thanks for joining me. You can always get in touch with me or any of our team over here at Zaner at 312-277-0110. That's my direct line. You can find me on Twitter, Facebook, or Hussey at Zaner.com as well. We also have a brand new product we just launched, and it's going to be in lieu of our newsletter, which you still have the sign-up links for in the comment section information of this video. But do check out our to sign up for our daily call with chief market strategist and VP of Zaner Ag Hedge, Ted Seifried, where you can call in every day, get his wrap on the markets, and in lieu of a written newsletter that is then, of course, going to be transcribed for subscribers for that. It's totally free. But I think we find that, I don't know, we want to be different. And I think that the newsletter is just way too treaded on of a product. You can get them from everyone, and they all say the same thing. This is our way of sharing our actual opinions with you in real time that are going to be ever changing, right? Once the newsletter is published, it's already old news. So have a great day, everybody. Have a better weekend in case you don't hear from me again, but we will be back with you as price action develops. Take care, everyone.